Hello and welcome to Trade Finance Talks. I'm Mahika Ravishankar, Deputy Editor at Trade Finance Global, and we're coming to you today from the 51st Annual ITFA Conference in Singapore. I'm joined by Alexia Somnolet and Charlie Salmon of Marsh, and we're going to discuss financing growth in times of uncertainty and the role that insurance can play. So to start, let's do a few quick introductions. Please just tell me a bit about your background and your role within Marsh and what brings you to ITFA this year.
Yes, absolutely. I'm a Vice President at Marsh in London, and I'm a receivables and supply chain finance leader for the UK. And then I also look after some of our banking clients on more general non-payment insurance within structured credit and political risk.
Thanks. And Alexia, how about you?
Very pleased to be here today. So I lead political risk and structured credit for Europe at Marsh, and I also look after our financial institution practice for Europe, which means servicing our bank clients at 360 degrees across all the credit insurance needs.
Thanks a lot. And to kick things off, I guess let's go straight into it. Charlie, there's a perception around the world, and definitely from what we're hearing at the conference, that in general business is getting more uncertain and riskier. But the Marsh Global Insurance Market Index found that actually insurance decreased for basically everywhere in the world for the second half of 2025. How can you explain this paradox, particularly in the context of receivables?
To start with, I think it's well acknowledged that there is a lot of uncertainty in the world at the minute. There's lots of geopolitical tensions boiling over. And in addition to that, we have the introduction of more tariffs globally that is causing much more uncertainty for a lot of large and small corporates. This is going to increase the credit risk environment, and then that would usually lend to a higher insurance rate market. However, certainly in the context of receivables and supply chain finance, there has been quite substantial growth in the supply of insurance. There are much more insurers now that are willing to support the risk. And this has led to a thinning of demand or the premium rates just because there's so much more competition out there. In addition to this, particularly with receivables and supply chain finance, which is a sort of a relatively less risky asset class in comparison to some longer term trade finance stuff, you will find that a lot of insurers would prefer to deploy their capital into these shorter term self-liquidating trade assets as opposed to something along the lines of, say, a leveraged finance or a real estate finance transaction, which is much longer term, and to it there is much more uncertainty attached to those longer term risks.
Okay, no, I think I understand, but you've mentioned more insurers in the market, but what about within the market itself? How is insurance adapting its offerings and products to banks and corporates within receivables and supply chain finance?
Certainly what I've seen over the last year or so has been a growing demand, for example, for under receivables transactions for cover to be taken on the supplier of a receivables finance program as opposed to the obligors. That can be on a full recourse structure, or that can even be on a limited recourse structure where there is secondary credit risk on the supplier. Under both circumstances, depending on the type of financial institution that are looking at these programs, you may be able to obtain capital relief, which is the big driver of demand for these kind of products. We're also seeing a lot more demand for portfolio transactions, whether that be a fully blown portfolio with a first loss structure, or whether that be a quasi-portfolio with a framework structure for which risks can attach to, that sit within a certain eligibility criteria. And that is one of the biggest drivers of demand at the minute, and it also lends to your first question around lowering premium rates, where when you have these larger scale transactions, insurers can take a commercial view in terms of the returns when they know that they're making such the absolute value of the premium is enough to justify bringing those rates down. So yeah, I would say they're probably the biggest drivers in the market at the minute, portfolio structures and these kind of quasi-structures. We're looking at the supplier and the receivables portfolio as well.
I also think that with the regulatory changes, the asset classes which are insured by the financial institution have changed, and therefore the market is also adapting to that, going from maybe some asset classes that they know really, really well and moving to others. We've seen growing demand for leverage finance. Fund finance is also booming, and portfolio solution, as Charlie mentioned.
Thanks, Alexia. And I want to come to you now on the subject of different forms that insurance may take. How can leasing at scale help companies free up working capital?
Leasing for corporates has three advantages, and then we can discuss of how the bank are financing this. So for a corporate, it's first a capital optimization tool, because you don't have to invest a huge amount of capex to purchase a machine. You can get it financed, and it frees up cash flow for you. The second, I would say, point is the balance sheet flexibility, because you move from capital expenditure towards more operational expenses. Therefore, it can enhance the financials of the company and therefore the borrowing capabilities. The third point, I would say, is also cash flow management, because you spread the payment over the lease term for a company, and therefore you don't have to have the upfront payment. Now, if we see all those advantages for a corporate, then the bank are now also increasing their willingness to support the bank to support their clients in this area. The issue is, from a regulatory standpoint, when you are a bank and you do leasing in general, well, you have different type of leasing, but if you have an asset as collateral, the regulation makes it difficult for a bank to recognize that collateral. And this is also where insurance can come into play, meaning that to help the bank support their corporate to have all the advantages we mentioned previously, then, and to be able to grow the business, then if the bank purchase insurance, it allows them to recognize a form of credit risk mitigation on that leasing financing. And this is really where the bank wins, the client wins, and all together we just help the bank free up more cash flows.
Thanks a lot. And on that note, are there any industries that you've seen taking up leasing that maybe wouldn't even have considered it 10 years ago?
So I think the industry who are adopting leasing, which were less present in the last decades, are everything linked to renewables and energy transition. So wind parks, you have also electric vehicles. You also have some technology that are now leased assets, which were not leased before. On the emerging sectors, we see also healthcare, who is coming into play. And the second one is manufacturing, which we see really as emerging and growing. And an industry where we think there is potential, but it's not necessarily there yet, is everything which is retail and agri-machinery. We see a little bit, but we think it could be much more developed in the market.
Charlie, are you seeing any trends in the types of risks which banks most want to transfer?
Interestingly, yes, in terms of longer term receivables transactions, so kind of similar to the leasing structures that Alexia is talking about. We're seeing a lot more of these contract monetization transactions, which can cover leasing or types of leasing. It can cover software licensing. It can even cover any contract for which there is a steady flow of payments over a longer time period. That, I think, has probably been the biggest growing sector that I've seen in the receivables finance space. I think one of the key drivers for that is for longer term transactions in the trade space, they're quite RWA inhibitive, and therefore it's quite essential that banks can transfer that risk out to AA rated insurers, or even to a lesser extent single A rated insurers as well. So that's probably been the biggest area of growth that I've seen over the last 12 months or so.
I would say another area where we see growing demand, although there is no standardization of transaction is really inventory finance. Banks who are looking to support their clients monetizing their inventory, and we are seeing lots of different structures, and I think the next step is for the market to adopt a form of standardization so that there would be a common understanding. And this is also something ITFA could work on, honestly, as a future working group.
That was Alexia Somnolet and Charlie Salmon of Marsh. Alexia, Charlie, thank you so much for joining me.
Thank you very much, Marika.